Welcome to the Agrihive Business Summit series. We hope Mark West will give some real insights to make tactical and strategic decisions for your business. The value is in planning around this information. Share this video and join a new wave of resilient businesses as they grow with www.agrihive.com. Have a great day.
Mark West is a partner at McCulloch & Robertson Lawyers in Brisbane. He's an expert in taxation law and dual qualified as a lawyer and a chartered accountant. He's a good man to know. Mark provides advice across the spectrum of taxes, and he's also a member of the advisory panel to the Board of Taxation. He's here today to talk to you in particular about what is coined flipping the industry. So I'm very interested to hear how you suggest we do that. Welcome.
So I should mention to begin with that the idea I'm going to talk about, I can't claim credit for originating it, as I'll show on the slides. Grant Fawcett is a client of the firm, and he had some ideas in this space, and I've been providing some help to him in the sense of developing the idea and in his attempts to engage with Treasury or to get people looking at the issue going forward. But the actual idea fits with a lot of what's been spoken about today. Clearly, part of the problem is the level of debt that exists, because of extraordinary circumstances that have compounded in the industry. So the general concept is that is there some way to release the tax losses that may be being carried forward by businesses in the industry in a way that will allow debt relief to be encouraged by the banks without having the banks go all the way to forcing in foreclosure, insolvency, and some of those things we've been talking about here now. So what I'm going to talk about, as I said, Grant Fawcett in particular has been looking at this and been trying to gather some interest in it. He's also had input from Professor Menez at the University of Queensland. And the context is the extraordinary circumstances, as I said. There's significant losses, tax losses we're talking about, funded in many cases by significant debt. So the idea is to be able to access those losses and to remove some level of debt, reduction of debt from the industry if at all possible. So broadly then the idea is to, the flipping I think comes from the idea of trading, although I put trading in inverted commas because as a tax advisor I know that Treasury won't like the idea of trading in tax losses, but perhaps it's a swap, as you'll see when I talk about the example. So the idea is there's losses in the system, they've been funded by debt, so the losses are real and the debt is real, but the losses are not going to be accessed by the actual producers because they're at the bottom of the chain and they're incurring there's difficulties being suffered at the moment. But if the bank were to write off the debt, if they were to take action and foreclose on the debt and say, well, we're only going to get this much, so we're going to take action, we're going to sell, we're going to write off some debt, well, they would get the tax losses. In a sense, it's the losses at both levels. There's the losses being generated at the producer level, and that's the same losses that are reflected in the bank might in fact need to write off. So there's various economic and tax issues in it, and we're only talking about prior year losses at this stage. And I'll just preface, and I'll come back to in the summary, that you can imagine that Treasury, when you talk about using tax losses in some way, would be very concerned to make sure that there's eligibility requirements, who could do this, and integrity rules, which is really anti-avoidance rules. But with those sorts of introductory comments, if I just lay out a simple example of what is being thought about. So maybe there's accumulated losses of $1 million and funded by $1 million of debt because the debt's gone into some expenses that have given rise to tax write-offs. So the idea is that the debtor swaps the tax loss to obtain a reduction of debt. So say the reduction of debt is 60% of the $1 million, then the full $1 million tax losses are worth $300,000 if I just for simplicity use a 30% tax rate, a company tax rate. I know that may not be the case in all instances, but for purposes of the example. So those losses in an economic sense are worth $300,000 because if future income is made by the producer, then they'd get deductions and they'd save that much tax. So in this example, the bank writes off and formally extinguishes, so it's gone forever, debt of, say, $600,000, but they retain $400,000 of the debt. And in that instance, the idea would be there'd be a system whereby they, however, could claim a full tax deduction for the $1 million debt. So they get the tax benefit, the 30% of the $1 million debt. So the bank's suffering a cost of 60% of the debt being written off, but it's getting 30% by way of tax saving the tax benefit. So their net cost is $300,000 to do that. Okay, and that's different to, for example, if the bank wrote off the whole $1 million and they got a $300,000 tax deduction, it'd be $700,000 cost. So they're keeping $400,000 of value here, and the cost is only $300,000. From the debtor's point of view, the producer's point of view, they have to accept they're losing those tax losses going forward. The bank's, it's been shifted up, if you like, and the bank's getting that. So they lose the losses going forward, but they're obtaining a reduction of the debt of 60%. So from them, it's the flip side. It's they get a relief of debt of 60%, but they've lost this tax benefit. So if they are profitable in the future, those losses that they would otherwise have had, they're gone. They've been included in this process whereby it encourages the bank to relieve some of the debt. Now, from a government point of view, because this will be important in terms of convincing Treasury to even entertain it, or the government to entertain it. So the government contribution, if you like, would be allowing this swap, for want of a better word, of the tax benefit at the producer, the debtor's level, to go up to the bank. And allowing basically the tax benefit to go up to the bank and for them to basically get a write-off of the $1 million, even though the bank's still keeping $400,000 in actual debt. So that's the broad scenario there. And what it does to the bank is it reduces the cost of the bank by 12%. So they're getting an extra 30% tax deduction on the 40% that they keep. So without getting bogged down in the percentages, it's a net cost of 30% rather than the usual 42% they get for writing off 60% of the debt. So they only get 30%, but you're saying, well, you're getting more than that, 30% of the 60%, which is the 18%, but they're getting the extra tax kicker at the bank level. Now, from the government's point of view, you can say to the government, this is a timing issue, because the deduction, if things didn't improve and if the bank pushed it all the way to writing off the debt, well, all that's happening is the deduction's being claimed earlier than would have been the actual write-off. And it's matched by the producer, the debtor, foregoing the deductions going forward. And the whole reason that the scheme is being proposed is that it's a better result that a viable business is not forced into insolvency or other actions and can get out from underneath, to some extent, the debt and the cost that that contributes to the whole economics of the business to become viable. And once they're viable and those losses are gone, then they're back in the system paying tax. So that's a very quick analysis of the thinking. And the thinking is those percentages can change, but the thinking is there's some way to, as I said in the introduction, release the value of those tax losses that are there to encourage some tax relief. Obviously that requires cooperation from the financiers, the bank side, and also some cooperation from the government. But my points here are that it's not that much of a cost to the government, or at least that view can be put to them. Various issues need to be addressed if this is going to go forward, and that there's always detail involved, but the concept is what needs to, I think, be at first proposed and accepted, and some serious discussions take place on it. Clearly, in the current circumstances, with budget constraints, there's a query about, well, what would the government be prepared to contribute? Hence the comments I've nagged a little bit about, well, what's their cost really? It's a timing thing. It certainly can be looked at that way. And then, of course, you need the bank's cooperation, because there's still there's some costs the banks are still incurring in terms of they're actually writing off debt, but you're providing some incentive to them, and if they would write that off anyway, as I said in the previous slide, it's better to be doing it in a way that viable businesses will be able to get back to viability. Hence, there will be issues about the eligibility criteria for this in terms of what businesses should qualify for this, and if it were to be seriously considered. And as I've already mentioned, Treasury will be concerned about integrity measures, are always concerned about integrity measures, but there are ways to draft legislation and to have policies for those things. And there's various economic rationales for why Treasury, wearing their economic hat, should consider this. I'm not going to go into them. The Professor is the one who can enunciate those, but that's part of what has been being talked about. So that's really what I wanted to explain. That's a proposal. Grant, I know, has been trying to get a focus on this. Without going into too much detail, there was a bit of a setback. Some of the progress that had been made, I think, at his end, with different changes of government ministers, etc., lost some momentum. But we were able to have some discussions with some Treasury officials about it to at least raise the topic, and they're quite open to discuss these possibilities. How far and how seriously it can progress is a matter maybe of what level of support there is to explore this further, but we thought it might be interesting for you to be aware of that sort of proposal. We're very interested in your thoughts. I could pass them on to Grant. I'll be here for dinner and for the rest of the session as well. I'm happy to take any questions if people have them, or leave you to absorb that, and you can grab me later tonight or tomorrow if you have any questions.
So I was just going to ask you, how would that, like in practical sense, how would that apply to that case study that was sort of...
Well, a number of things that occur to me are you'd have to have some proposals about whether they'd be eligible. So even though if the numbers haven't got them, I think, in losses, but they may well have tax losses because of the tax difference to the accounting, because of various deductions, etc. So if they've got tax losses, the idea would be if this were to be operative and they were eligible for it, then it might be possible to talk to the banks and say, well, will you write off a certain amount of the debt? You get the additional benefit of the tax swap on the benefit of the tax losses in order to negotiate with the bank to have some debt relief. Maybe not all of it, but some debt relief that would help to make the financials look better, reduced interest costs going forward, that reduced debt. And in the circumstances that, as I heard everyone talk about, the case study probably reflects extraordinary circumstances of the live beef disruption, the drought, etc. The bank lending when property values were much higher. I know these are very much on Grant's mind, and so the debt is very high in the case study. And if you can take a slice out of it, and you can provide an incentive to the banks to take a slice out of it, and the government's prepared to, they'd have to amend the law to allow this to happen, prepared to engage with that being a possibility, it would help. It wouldn't be a total solution, but would be one of the things in the armoury that you might contemplate to assist. They'd have to then still make a decision about all the other things we're talking about to make the business viable, but it's possibly part of the solution.
I think I'll be right to Carl. Mark, with your scenarios, have you looked at a dollar for dollar basis with the banks, so that, I mean, if the bank's got to take in that scenario 300,000 they've got to write off, at best they'll only consider it in we've had the 12% of loans are non-performing. So
yes,
out of that, it's maybe only 5% of cases they look at. Do you see it on a dollar loss being matched for a reduction in debt, or do you see it as that 2 for 1?
The percentages can be varied, but it's a question of how much the government might be prepared to let the losses be traded as well. I know that in other areas of tax law, the idea of trading of losses or excessive losses being utilised, Treasury is always very sensitive about. But the possibility of saying, well, look, we can trade that many losses and get rid of more debt, I mean, certainly that can be considered. It's just, even in that example, what's happening is that, it's just, I've just assumed certain percentages. So if you wanted to push it to 1 for 1, you could try to do that. But you're still saying that you're giving up, if I'm understanding you correctly, say if they had $1 million of tax loss benefit, then trading that for the debt, well, if that were possible, that would be good. But the banks probably have to take some cost in this as well, if it's going to be viable.
I'm looking at the other way. You're trading the 30 cents in the $1 million, so the 300,000.
Yep.
Trading that for a reduction in bank debt of 300,000 instead of 600,000.
Well, that's
the bank's not taking.
Yes.
The bank will consider it without taking any hit.
Yeah, and I think you'll probably find Treasury would have a difficulty with that. I'm not speaking for Treasury here, but they will say, well, you're basically, the bank's still not really, the bank's getting the full tax benefit of having written off the $1 million debt and they're keeping 700,000. I think from an economic point of view, they're going to say, well, the bank should be not getting the benefit of tax reductions without incurring some, at least, of the cost. So I understand what you're saying, but and there's no reason why that can be proposed. I suppose I'm anticipating the response will be that's not acceptable, because it really is just back to the trading of losses in a sense, giving the losses to someone else, but they're still saying you still owe me everything else and they haven't borne any cost. So the bank's tax deduction, I started off talking about how the banks, it's 2 layers of the losses. The bank only really gets that 300,000 as a tax deduction when it incurs the cost of the $1 million loss. So to say 1 for 1, you get into a territory where the bank is not suffering any loss, but it's getting a tax benefit through the system, and I just anticipate that that will be several steps too far for Treasury, because they will say, well, no one else can trade tax losses like that, why here? I think, my personal view is that you've got a chance of getting their attention and saying, well, we should have a special system here because of particular extraordinary circumstances here and the nature of the debt problem, but there will still be those sorts of concerns that we do not want to set a precedent any wider than is reasonable or necessary across the whole tax-paying population of trading tax losses. And that'll be, I imagine that's the biggest problem, is getting a policy decision on it. There will be concerns about that. But there are extraordinary circumstances here. So sorry, hopefully I answered it.
Thanks, Mark. Well, the only thing I see by that is that, am I right in thinking that it would make no difference to Treasury, that change in scenario, but could potentially help a lot more producers to reduce that?
It could, but the Treasury concern will be, look, at the farmer level, at the producer level, they've just traded their $300,000 tax losses, and they've given them to someone else, and they give them to the bank, and they're getting the benefit of that. And it's not a replacement of the losses, the deductions they would have got because they haven't written off the debt. And I think that will be a significant obstacle. But it's a question of talking to them and saying, well, why can't we do that? And if I'm anticipating the response correctly, recalibrating. But at this stage, even getting them to accept the concept that there should be some swap. I think we've used the word swapping credits rather than trading because of the sensitivity of the idea of trading. But it's only trading between the financier and the producer. So it's not trading, I'm not going off and selling you my loss company, whereas you pay me for the loss company, you go off and use it for something else, which there's rules about. This is a particular relationship that's causing particular issues, and the tax policy might have to follow what is another broader policy decision. Any other questions? There's a gentleman.
Do you see it as a policy going forward, or do you see it with a life to run? And theoretically, would I be fair in assuming that you could theoretically pay down debt quicker by accumulating tax losses and retiring debt a lot quicker than that than by actually making profit?
The current discussions are about prior year losses, because you can make the case for prior year losses that it's because of the circumstances that have happened over the past, which have not been planned, that we're looking to use this for. If it were to be going forward, there's another layer of considerations then, because if you have a proposal like this and there's ability for people to plan into it, you get tax planning into it. And so my response to you is, at the moment, we're talking about prior losses, but the reason being that, again, there'll be a heightened, as I was say, I can't speak for Treasury, but just from experience in dealing with them on other consultations, and you can understand that they're legitimate concerns, that once you introduce certain tax laws which provide a benefit, you engender change of behaviour and people plan into it. And what is trying to be achieved here is to help to provide part of a solution to an existing problem. My advice would be, look, not muddy it with producing situations where Treasurer will say you're providing an opportunity for people to alter their behaviour to take advantages. If you can draw a line and say we're trying to deal with this issue, people can't plan into it, people in it or not, and you can set appropriate rules around it, much better chance of getting engagement from them, I would suggest.
I would suggest it would be muddied fairly quickly.
Depends on the integrity rules and Treasurer will want to have those. If I'm taking meaning correctly, there will be people will look at it, and that's the design. Though is a matter of detail, some level of detail. The concept is even at this stage, at the concept stage of whether we can get engagement, that this is something they want to talk about, think about. Sorry, I didn't catch where that came from.
This is not so much about tax losses. Can I address a question to an accounnt?
There's other accountants here. I'm an accountant, but
you'll do.
No, I'll direct it to Bill and Rowan.
We had a business years ago. It was a motel, and we went to sell it.
Yes.
Now the people who were interested in buying it, they weren't interested in what it looked like or anything else like that. They're interested in how much profit we made. And they multiplied the profit, say, by 10. Say we made a $100,000 profit. The motel was worth $1 million. Now, historically, the land, they say, has got a return of 2 or 3%. And if you ask an accountant, he'd say, well, you're crazy to invest in the land. Say you wanted a 10% return on the land. Kidworth and they've paid too much for their land, you could say, hypothetically. Mm-hmm. So they paid $140 an acre for the land, and with a 3% return, that's stupid. They should have only given $35 for that land to get a 12% return on capital. How would an accountant see return on investment on the land?
Well, I think the comments that have been made about the comments were being made about, well, maybe they should exit and buy it back at what the current value is. I mean, the past is the past. Oh, well, I mean, the market is the market. Sorry, maybe I'm not addressing the question, but like it or not, the market is the market. And I think that the only advice you'll get from lawyers or accountants is you've got to deal with where things are at now, and there's sensible decisions got to be made about whether people pay too much for the land in the past, what is the value now, what business decisions are you going to make going forward. The relevance of the past is that linking back to what I'm particularly talking about, is the past is you might have some debt from that time, or you might have borrowed against the value in the past and you've still got the hangover of that in the debt, and you've just got to make some decisions about, I think Bill was talking about people making sure they pay back principal and things like that, but that's still hard to do when the debt is so large. And this particular thing I'm talking about is not meant to be a total solution, but I think it's an interesting idea. I think it has some merit maybe a part of a solution to reducing the debt. But it needs the cooperation of the banks, it needs the cooperation of the government, and there's a road to go. But I would be interested in people's thoughts if they want to express them to me, or even to Grant, because I know he's still trying to move this on, and as I said, I'm trying to assist him where I can.
We'll have to leave it there. Thank you very much, Mark.